much. Very excited to be here. It's amazing how the fintech lending space is changing over time. We used to go all the time to do the road between New York conferences, Miami conferences, and Silicon Valley, and now we are down here. This is my second conference in 6 months, so very happy to have like a new region emerging in the global territory. My name is Sergio Furio, founder of Creditas. I founded Creditas 12 years ago. Creditas is a $4 billion company, $400 million in revenues, 2,000 employees, present in Brazil and Latin America. My objective for the next 10 to 15 minutes is to share with you some learnings, what we have seen in a geography like Latin America, what has worked, what hasn't, and hopefully we can contribute each other with our common knowledge. So this is the story of my life. I was born in Spain, started my career in banking, then moved to consulting, but always with banks in 2008. Decided it was an exciting time to move to New York. Moved to New York, saw how the capital markets were collapsing in the region, and started the technology transformation of a couple of banks in the US. 2012, decided to give it a shot to become an entrepreneur. And one of the first things that I did was to try to map what the opportunities in the States were, what the margins were, what the opportunities for disruption, and I see very close to none. Everything was quite efficient, quite effective, very productive. It was like a machine that was working well. And then suddenly I met my wife, that is Brazilian, and she introduced me to the Brazilian banking space, a space that I'm going to introduce to you, and hopefully we can get some learnings from that era. I've been there for the last 12 years, and hopefully I have like some insights on the region. So very clearly, we as entrepreneurs, we look for anomalies. And these were the first one that I noticed, very basic. If you take Europe versus the US, it's a tale of, one side Europe, banks that keep the loans on the balance sheet, and then therefore the ROEs are relatively low. And then on the other side, the US, that typically pushes, especially the mortgages, out from the balance sheet. With that, you reduce capital consumption, you maximize fee revenues, and then therefore you maximize return on equity. That's the two strategies that I think that simplifying we can see in the world. And then suddenly I saw what was happening in Brazil in the incumbent sector, which essentially they were keeping the loans in the balance sheet, but still managing somehow to get one of the highest ROEs in the market. So that caught my attention. And as I was a consultant at that point, 12 years ago again, this is a slide coming from 12 years ago, 11 years ago. And essentially, it very clearly states that Brazil is an anomaly. It has a combination of very high margins and at the same time, very high volumes. The size of the balls is the total debt service, which is the total amount that consumers pay to the Brazilian banking industry, including both principal and interest. We always put a lot of attention as business people in what the margins are, what the revenues are, but at the end of the day, we also need to take care about what the consumer is paying, which also includes the principal. And then therefore, the maturity of the lending product is also very relevant. In Brazil, high revenues, but also very short maturity. That pushes a lot of PMTs that need to be paid by the consumer. And that's why the size of the ball in the case of Brazil is so high. So when I finished this slide, I said, okay, so this looks like a nice trip to be done to Brazil. So I did my first trip in December 2021 to meet a couple of people, and then suddenly decided that was great. And the reason is this third chart that you're going to be seeing here, which is the reason why that spread is so high, why there is such an amazing anomaly in Latin America, especially in Brazil. On the x-axis, what you have is the volume. So this is the total $700 billion roughly of outstanding consumer debt in Brazil. And then you have a ranking of financial products, of credit products in the country. A credit card overdraft and personal loans, obviously the most expensive products, but very interesting to see how expensive they really are and how big they are in reality. If you compare this to the US or Europe, they would represent 3-4% of the market. In this case, it's close to 20%. So this is a $240 billion revenue pool. And those three categories that are unsecured, no collaterals, very inefficient, they represent $140 billion in revenues. You will see in the next slide that a bunch of disruptors suddenly came 10 years ago trying to use technology to disrupt this very clear space, this low-hanging fruit that was there in the market. Another data point that I realized that was quite interesting as well was the number of branches and then the productivities per capita and per branch. 80,000 branches in the country, that was leading you to approx $30–40 million per branch. That's 5 times less than a branch in the US or Europe. That lack of productivity was being replaced by significantly higher margins. So at the end of the day, the branch was at the core of the problem. It was okay to be 10 years ago with inefficient, unproductive branches. But then suddenly, I think that the beauty of this thing of transformation is that you can probably anticipate 10, 12 years ago that something was going to change and that the technology disruption was going to be able to change this paradigm. Unfortunately, that didn't happen. This is pretty much the same story as we have today. A bunch of disruptions, but still very small compared to the total size of the opportunity. Even with the largest digital bank in the world that we have, Nubank, still extremely small compared to the size of the market. We are in the early innings of this opportunity. And then another thing that caught my attention, $3,000 in average loan per capita, also extremely low compared to the amount of debt service that the consumer is paying. So a clear opportunity was being emerged. And the consumers were really eager to find new solutions, new opportunities, and that happened across all the different verticals in banking. In lending, you could see that we used to have the highest lending interest rates in the world, highest spreads, regardless of the risk-free rate. This still happens today, no changes. In savings, we had negative spreads for saving accounts. This is an extremely popular product in Brazil. 300 basis points spread, negative spread, versus risk-free rates. That's the most common product in Brazil, extremely low quality. In investments, very expensive money market funds. It's money market, so there's nothing, no secret, nothing that needs to be done. Still 3% fees. And then finally in payments, merchants were being completely write off. So the merchant discount rate that were being paid 5% plus. So you had like a store, you wanted to collect money through a credit card, you pay a 5%. That was the paradigm 5 to 10 years ago. And essentially, a bunch of players in the industry started seeing that this was a very cool opportunity. That technology could make like a huge difference and that each one of those small verticals could be attacked. In digital banking, all of you guys know about the story of Nubank, but we also have other disruptors in Latin America, Neon, Banco Inter, C6. In investments, we have our own Charles Schwab in Brazil, which is XP, with a very cool model, grew to R$1 trillion in assets under management. In payments, this was one of the first verticals to be disrupted. Stone, PagSeguro, GetNet, all of them were just like using technology to slash the price for the consumer, for the merchant, reduce the merchant discount rate, and then with that gain market share. Those 500 basis points that are being paid by the merchants today, they went all the way down to 150, 200 basis points. So tremendous effort to lower that. And then finally, in secure lending, as I will mention in a second, Creditas also disrupting the market. So just digging like a bit deeper in one of the examples, which is in our case, Creditas, what we did was very simple. And I think that most of the principles that the companies that we are seeing being successful today implemented 10 years ago were extremely simple. And in our case, it was a combination of technology and a very easy to understand problem and how to solve it. So on the one side, 10 years ago, very clearly, mobile was going to disrupt the market. That was a clear disruption. Mobile, period. I will mention like a bit more about this type of disruptions. We need to cut our attention on, because there are like so many hypes through the life of a company, and you are so tempted to get into that hype. And okay, I'm going to invest in this, I'm going to invest in this and this and this. In reality, if I simplify over the last 10 years, mobile, that was the only thing that really made like a huge difference in consumer products for financial services. So on the one side, let's invest in technology. And then on the other side, it was, okay, how can we take that lending product that is extremely low quality that the banks are offering, how can we reshape it by using the technology? And then we took like a very simple concept, very traditional in the US and Europe, which is let's take the assets. And then the first thing that I got to Brazil, I see this type of thing, like a traffic jam and a lot of buildings. And then the next question was, okay, what is going on with those assets? And what we realized was that 75% of that value of those cars and of those houses were unencumbered. So they were not being used to finance anything. They were being owned outright by the consumer. So then that was, boom, that was the opportunity. Very straightforward. Let's use a digital technology to connect with the audience, to reduce the customer acquisition cost, and let's use that same technology to create an infrastructure that allows us to underwrite physical assets at a very low cost and use it as a collateral to deliver a cheaper financing with longer term, better opportunities for our consumer. That was the essence of the company. So today, that's what we do. We support Latin American consumers to access and protect their assets. We say also protect because we built the largest online digital broker in the country, and we do this in 3 sub-verticals: your residential real estate, your car, and then your employee benefits, your salary. We use your salary as an asset. We place a lien on your salary so that then we can collect directly from your company, avoiding your default and then therefore lowering your interest rates. We do the same with the car, we do the same with your house. So the core product of Creditas is providing liquidity to the Latin American population at significantly cheaper rates. It's very simple, very easy. Now technology is the big difference, and that's where you invest all your money. And we do all this with a simple, easy to access and affordable solution. Even though this concept was extremely easy to understand, very simple, and everything went extremely well. So you had the disruption of mobile, the consumer changing, the consumer really wanting to have something better. Even everything was all in our favor. It was a mess. It was like extremely difficult, extremely complex, and I will make some reflections on that in a second. But I remember back in 2012 when we started the company, 2013, 2014, 2015, everything looked like it was going well. I mean, we were looking to like a bunch of indicators that were saying that we had like users, that we had like people that were interested and so on. But in reality, in retrospect, that was obviously, we were at zero. We were not doing anything yet, no product market fit, and it really takes time. Even though you have like an idea, even though the consumer actually wants you, they're hesitant, they really don't know who you are, why is it that you're offering that. In some cases, people were thinking that we were a scam. They were saying, dude, what the hell? This is a gringo that is coming to Brazil and trying to create a scam by charging such a low rate to the consumer. That doesn't even exist here. And it took us some time and obviously some capital, because time actually requires money to fund the operation. But then since 2019, we got into a boom. 19, 20, 21, scaling the company very fast. Then suddenly 22, 23, a change in the market, you had to adapt. You need to look at a different thing. Then suddenly they changed the rules of the equation. Now it's not about users. Now it's not about like volumes. Now it's not about revenues. You also need to generate profit. Okay, you changed me the rules of the game at that point. And I will make some reflections on that in a second. But then suddenly, what we said, okay, so we need to focus on expanding margins, and then on the right-hand side, you can see gross profits and operating income at the end of the day. And we were seeing before in the plenary session, the CEO of NASDAQ saying the new wave of companies that are going to be IPOing are going to be different than the ones that IPO'd 2, 3, 4 years ago. Robust business models, very clear margins, scale, traction. They need it all, and in reality, this is the Fintech 3.0 that we are seeing today. It's not only about having like a cool app, a nice feature. You really need to have your revenues. You need to get your margins in place, your unit economics, and you need to be ready to scale properly and fast. How far are we in our journey? We're like at 0.3% of the market that we are trying to attack. So still plenty of room for growth, and this is only Brazil. Then you get all the expansion into the rest of Latin America and the world. So just to get into into my final page, and hopefully I'm not disturbing too much from the first day of the conference, but 7 reflections or learnings that I think that are important, at least for me, and that we think about it all the time. The first one, it is more difficult than what it seems. There are like so many stakeholders in the game of building a fintech company everywhere in the world. Definitely in emerging markets, sometimes you even need to build the infrastructure because there's no infrastructure or something. You need to convince the customer, you need to educate the audience, you need to manage the regulator. But it also happens in developed markets. There's so much competition. It's different type of problems. So Probably in emerging markets, it's more about fighting with the complexity versus in the developed market in which fighting against your competition. But these stakeholders include many people that then suddenly you need to master. How do you make advocacy with the regulators so that the new regulation comes in your favor, or actually in the favor of the consumer, so that you can actually push a change in your country? Extremely relevant. How do you adapt to the technology? How do you select the right technologies to be implemented? Again, if you think about the past, many things have happened, and only 2 or 3 were actually really great ideas. How do you collect the capital that you need? How do you manage the resources, your team? And then speaking about team, obviously the second point is the most important factor that defines the future of the company, and it's never overstated. It's so difficult to build a company. You need to be resilient, so then you need to make sure that your team actually is together with you, is going to be pushing to the limit, and is going to be suffering as much as they can, and together with the families. The mindset of that team is crucial. That's what really makes it or break it. There's one sentence that we repeat again and again at Creditas, which is companies don't die because they lose money. They die because they lose energy. Really, the energy is what really makes the big difference. So really push the energy to the maximum. The third key learning, it's about the target market. It really needs to be huge, and that's the beauty of fintech, is that we're attacking things that are extremely big in nature, but then it tends to bring you to the simplification that, it's such a huge market. If I just take like a 1%, then I'm going to be like a billionaire, and the reality is like a bit more complex than that. Why is it that your company is worth existing in the market? And this is like a very hard question that we as entrepreneurs, sometimes we don't ask enough. We need to look at the mirror and say, do I really have, or am I really building a competitive advantage, something that it's very hard for someone to actually develop? Most of the time, the answer is no, you're not worth living. And that's why so many companies stop operations. Number 4, navigating what we call the microcycles. If we think about the last 10, 15 years, tremendous wealth generation. It has been like a straight up amazing time. But in your life as an entrepreneur, it's full of microcycles. Every single day is like a different moment, and it feels like it's a different world that you're operating. So how do you adapt yourself to that changing environment? And that changing environment, if I just take the last 10 years, I typically am simplifying in 3 stages. 2012 to 2016, 17, that was essentially the 1.0 of fintech. It was trying to convince the world that we, as an ecosystem, were worth existing. The banks were neglecting us. They were saying that we were cheaters, that we were not even we were outside of the regulation, that we had no clue, that we were like a bunch of idiots operating in the market. That was the reality. We don't remember it anymore, but that was what we used to hear 6, 7 years ago only. Then the second stage went from 2017 to 2021. That was a presence of capital, extreme abundance. Then you had like the macro funds pumping money into the economies. That was very nice. Obviously, it was a party. The problem with the party is that it was inflated the prices of the drinks. So then suddenly hiring a developer was 10 times more expensive than what it used to be, especially in emerging markets in Latin America. Suddenly the price per developer went to the roof, and that obviously made things much more complicated to build businesses, and forget that actually you had like so much money and you actually had to implement all those changes. So that was the second cycle. The great thing about that is that the presence of capital allowed you to actually build companies at scale and testing your engines at scale. Very, very relevant in the type of industry. And then suddenly 2022 until today, let's call it, a complete focus on profitability. Especially in late stage, it's all about how can you pump expansion, how can you pump up your margins, how can you make sure that you are profitable, that you have great unit economics, and you can scale that. That has been the story. This is going to change. I mean, there's no way that it stays like this forever, but obviously that puts like a lot of pressures in founders so that they can adapt in those different cycles. Number 5, we always say that we are attacking complex problems, but we really need to think carefully about it. There's a good part of the complex problems, which is the long term, but the short term is extremely challenging. The higher the complexity of the problem, the more difficult the short term is going to be, but also the more competitive advantage that you're going to generate in the long term. In FinTech 1.0, there were like a lot of companies focusing on non-complex problems that were like very easy stuff to do. It was great so that you can start at the business. The business was growing very quickly at the beginning, but then suddenly it was reaching a ceiling, no opportunities for growth, and really bad unit economics. You always need to find the balance. How can you get into a market that is like a bit more simple and then quickly get into the complexity? The complexity is our friend. If things are not complex, banks are always going to win. There's no way, we have no chance. It really needs to be as more difficult as we can. Number 6, be careful with overhyped themes. Over the last decade, we have seen a number of different initiatives that were going to change the world, and most of them, they didn't. So now we also need to think about the new things that are happening. How can we use AI in the right way? But what part of AI exactly that we want to use? How that's going to help the banks or the fintech companies in being more efficient? Finally, finding the right balance between building a huge company, a big dream, something that really inspires everyone in the room, our teams and the customer to be better with our lives, but also at the same time to try to build a business that is sustainable and can thrive. Just like a final slide with an acknowledge to everyone that has supported Creditas over the last 10 years, investors like Fidelity, Wellington, SoftBank, Kasek. Very proud about that team. Thank you, everyone. In case that anyone has like any question, here's my email. Thank you, guys.